Hello and welcome to CNBC Africa's special broadcast of the outcome of the July Monetary Policy Committee meeting of the Central Bank of Nigeria. I am Wale Famruwa and many thanks for joining us. This MPC meeting is against the background of rising global trade tensions as well as the normalization of monetary policy by both the US Fed and the European Central Bank, which has contributed to the flight of foreign portfolio investments from emerging and frontier markets. Now, domestically, the inflationary impact of possible rise in pre-election spending and the reduced food production as a result of the conflict between the farmers and herdsmen in North and Central Nigeria are issues that the MPC will also consider. The central bank is widely expected to maintain its monetary stance as it adopts a wait-and-see approach. If it does so, this will be the 11th consecutive time that it has held Nigeria's baseline interest rate at 14%. However, the bank is also under pressure to cut rates to boost the country's economic recovery from recession. Before I cross to Abuja to hear from the central bank governor, joining me in the studio to preview the announcements are Bismarck Rewani, the CEO of Financial Derivatives. We also have Tilewa Adebajo, the CEO at CFG Advisory. And joining us from Johannesburg is Jaron Meersen, derivative trader at Rand Merchant Bank. Gentlemen, thanks so much for joining us. And as usual, Bismarck, I won't start with you. You are calling no change today.
No change. Justifiably, yeah. Because the risks of higher inflation are now more potent than they were earlier. Now you're dealing with anticipated inflation because the spending has started. The election season is here. The outflows, $4 billion of outflows so far, of FPIs so far. The reserves are beginning to drip. This is the time to defend. In any case, no central bank in the world, 8 months to an election, alters anything because it will be considered politically motivated. Having said that, remember that last time they made a move in October, yes, when the election was due in February, and the election got postponed.
Right. All right. So, but let me get your perspective on what we're dealing with in terms of the scenario in the second half of the year. Everyone had expected that the second half will be, if you like, the tougher bit for monetary authorities and indeed investments in general because of the elections. Given the pressure that we're expecting from pre-election spending and what we're seeing already in terms of the month-on-month inflation numbers, do you think there's any case for a hike at all, or would that be suicidal for the
I would say there's a 10% probability that will happen. I doubt that will happen because that will, you see, monetary conditions are already tight. Credit to the private sector has declined by over 6%, right? And money supply is growing at about 4 or 5%, way below the target. So you don't want to worsen it with tight monetary policy. All you do is maintain the status quo. But more than any other time, this is a time that maintaining the status quo makes more sense.
Right. Tilewa, would you agree completely? Is there anything else you want to add to that?
Well, I tend to take an alternative view, and the reason why I take an alternative view is the fact that when you take a look at the underlying numbers for growth and GDP growth, you see we're suffering. Quarter on quarter, you've seen a -13 decline in GDP growth. The projection from Trading Economics for this second quarter GDP growth is 1.6%. We did 1.8% in the first quarter, and we closed last year at about 2.1%. So clearly, the trajectory for GDP growth is on the negative downward trend. Our growth rate, our GDP growth rate, is not matching our population growth rate of 3%, and it's no longer news that we're now the global poverty capital. These are the sort of things that are impacting our economy, and you have to take a look at that side. Unemployment is close to 25%. And the stimulus that the budget was supposed to bring out to get the growth going, because of the delayed passage of the budget, we're not seeing that stimulus with the capital expenditure.
Do I hear you saying that there's a case for easing here?
Yeah, there is a case for easing, but unfortunately, I think the central bank is setting its sights on single-digit inflation before it begins to put that rate cut in place, which I think would, by that time, you find that the economy is going to start contracting. And unfortunately, what you find out in the sense that we have leading indicators and we have lagging indicators. And if we do not address these issues, credit is tight, as Bismarck has pointed out, and there is no stimulus in the economy. So the election spending is actually welcoming. So in order to reflate the economy, I think that we can manage the inflation at a later point in time. But right now, we need to grow this economy.
Before I go to Jaron, do you want to respond to some of his views on the implications of keeping monetary policy tight at this time?
Well, you see, if you're looking at long-term growth, I agree with what he's saying. But right now, you're looking at stability. Stability in the exchange rate, stability in prices, right? And right now, I can tell you that with the $4 billion have gone out so far in the last 2-3 months, let us assume that FPIs all go out, because I know that's not going to happen, but if that goes out, your reserves will actually come down quite significantly. It's still a comfort zone, but that will cause some concern, because not just FPIs, some Nigerian money also, there'll be some capital flight. That could put some pressure on the currency. So for now, until the election, I would say maintain some stability. After the election, we now address the structural issues, which are that you need fiscal boost, you need the stimulus and all of that.
All right, let's now head to Johannesburg. Jaron, just want to get your perspective on what's likely to play out in Abuja today. And I'm sure you've been listening to my guests in the studio. What are your thoughts on the dilemma that Nigeria is in at the moment? We're trying to drive growth, but at the same time, there's that inflationary pressure coming with the elections, and of course, there's concern around the currency.
Absolutely. So it's, as the previous guests have highlighted, it's a tricky decision for the MPC today. Clearly, something needs to be done about the negative per capita growth that Nigeria is experiencing. There's been, the MPC has been kind of in defensive mode for the last year or so in order to defend the currency and attract investments. And now that that has been achieved, I think there's possibly a bit of room for a sneaky 25 basis point cut at this meeting. At RMB, our official view is for the rates to be on hold, but if you just look at a potential symbolic 25-point move, it's not enough to deter foreign investment to reduce rates by 25 basis points, especially considering the fact that market-related interest rates are not really affected by the MPR as such. In fact, by cutting rates, it would be aligning the symbolic monetary policy rate with market-related rates, which are trading at around 13% in the 270-day region of the T-bill curve and just about 14% in the bond curve. So I think it would be potentially supportive to the many foreign portfolio investors currently invested in the fixed income market, just to give them some support and to say that almost to encourage the view that inflation's falling, the MPC is cognizant of that. However, they are being cautious in order to take into account the global risks such as trade tensions, such as the Fed hiking interest rates, the ECB and the BOJ considering tapering their QE into the future. So 25 basis point cut kind of balances all these considerations quite nicely.
Right, but Jaron, and if you can make this quick because we have to get to Abuja shortly, I'm trying to get your thoughts on what a rate cut could actually achieve in the current environment. In the MPC has clearly indicated in prior meetings, and I think the economic community, community of analysts and economists are suggesting that the inflation expectation is that it's going to get worse, even though we're seeing it getting better, so to speak, on a year-on-year basis. So there's that clear expectation that inflation is going to get worse. So if you cut rates now, does that suggest that you're going to be depending primarily on the OMO activities that we see the central bank gets involved in weekly in the Nigerian market?
Sure. So the inflation forecasts are clearly for a pickup in inflation. I think a lot of the analysts forecasting high inflation are looking at historical perspectives where there was increased spending into an election cycle. We saw this being the case with the supplementary budget being approved for election spending, so it seems to be playing out to some extent in Nigeria. However, the difference between this cycle and some of the previous cycles is that the currency is effectively under control at around the 360 level. It's pretty much not necessarily pegged there, but it's extremely stable around that level. So it's unlikely that any election-related spending will feed through into the FX market, and therefore that channel through which inflation moves into the real economy is actually going to be postponed. If you then step back and look at the structural forces such as weak growth, which we've already highlighted, a currency that's been stable, and inflation moving a lot lower, it looks like inflation expectations are trending lower, and certainly the trend is for inflation to actually move into single digits sometime this calendar year. So with that expectation, I think it certainly makes sense for the MPC to start very gradually moving preemptively in order to deal with the critical growth mandate that they have to consider.
Jaron is suggesting single-digit inflation. Does
No.
that sit well with you as
No,
well?
I
Because
don't-
I think more and more people are suggesting that
Look,
the inflation
annualized month-on-month inflation is now 15%. The divergence between monthly inflation annualized and year-on-year inflation is about almost 5%. We are at the tipping point. We have not factored in minimum wage review.
Yeah,
We have not
which is
factored
possible.
no, it's
Likely.
likely.
More likely.
The chairman of the party in power is also a former NLC president, so this is their terrain. I think you have to take that into consideration. How much stability are you going to maintain in the run-up to the election? After that, then you deal with the problems. The problems are not going to go away, but I don't think this is time to...
Right. But Tilewa, how do you juxtapose your view that we should cut with the fact that that inflationary pressure is coming? It's there. Even the MPC has acknowledged it. I think most of the
I don't
analyst
agree.
community
I don't agree with the inflation
The expectation.
because if you take a look at the accelerator and then you look at the components that factor in, inflation was a cost push inflation. That's why inflation got to 18%. The issues are the fundamentals and the dynamics of the market. The election spending is overhyped and is actually quite necessary for the stimulus for this economy this year. Anybody who does not know that the foreign portfolio investors would leave, we should have discounted that into our reserve levels. So there's nothing there are no shocks, there's nothing new. So what we need really is the growth in this economy. If inflation continues to fall at this rate, and I think we'll definitely before the end of this year we'll see inflation at single digits. But the argument really is the fact that you cannot wait until inflation gets to single digit before you start cutting, because clearly growth has stalled. And if you stall growth in this economy, then you're going to have more challenges going forward. Because right now you have stability in foreign exchange, you have stability in a lot of interest rates, and as been said earlier, market rates have adjusted quite easily. There's no credit. Public sector financing is beginning to crowd out private sector funding. So you can't provide the stimulus. So the stimulus for growth is going to come from election spending, and probably the capital budget for this year, only in 3 months. You're not going to see that effect in this year. That effect is going to come out maybe first quarter next year. So in order for us to do something, what I see is the fact that what we need to do, we need to start focusing on growth, and we need to start focusing on unemployment. Those are really what will impact this economy. But unfortunately, we have a Federal Reserve Bank
or a central bank
that is fixated on trying to achieve single-digit inflation before they move. So, and I think that we need to understand that economics, there's leading indicators and there are lagging indicators, and the adjustments or the things that you do now will have a lag effect, and you should do that now to be able to see the benefits by year end.
I sense you want to respond to that.
No, my point is just that, let's look at it. Effective interest rates have come down from 18%, treasury bills, all the way to 13%. Liquidity is in the system, yet the banks are not lending. Even if you bring down interest rates symbolically, the question
what do you
is,
achieve?
What do you achieve? Are the banks going to lend? No, the banks are not going to lend. The banks are so busy trying to deal with the impact of IFRS 9 and expected credit losses, right? They're trying to fix their balance sheets. They're trying to raise capital. So that is the thing.
They're going to be even more conservative.
More conservative right now. So I believe that even if you bring down interest rates, nominal interest rate for whatever it is, the MPR is not an anchor rate that that drives the market. So it will just be another pie in the sky. The reality is that how do you get the banks to start lending in a transparent manner.
Right. And while we wait for the central bank governor to speak to us, I want to get back to Jaren, and let's now talk about the exchange rate. And I was speaking to the former member of the MPC, Dr. Doyin Salami, earlier this week, and he was of the view that the exchange rate is likely to be stable, whatever happens between now and February. Do you share that sentiment? And how significant do you think it is that foreign investors still are invested in Nigeria for that to be a reality?
Certainly, I agree with the view that the exchange rate is going to be stable. It's very much a controlled currency, and I think the central bank is very comfortable with current levels. I think it would be politically unwise for the central bank to look to liberalize the exchange rate before elections. I know some of the political candidates for president have been actively speaking about exchange rate policy and what they're going to be doing with it should they be elected. So, you know, it's something that goes beyond the central bank and you know, more into the Ministry of Finance and the president's domain to look at potentially moving the exchange rate. I don't think there's any pressure necessarily to
sorry, Jaren,
adjust the
I think
exchange
I really
rate.
have to interrupt you. So sorry to interrupt you, because I think we do have the central bank governor ready.